Hey everyone, we're trying something different with more long-form content. This is the first of multiple deep dives into industry accounting topics. The first of these series will be covering oil and gas accounting. We'll do a deep dive into many topics, but this first video will focus in on the basics. Future episodes will be on depletion, impairment, and asset retirement obligation. So stay tuned. If you learned something new, please like, share, and subscribe. Without further ado, here's our first seminar on oil and gas accounting and the basics.
So basically, the natural resources industry group is made up of these segments you see here. Upstream, which is going to be your exploration, drilling, and production. You have midstream, which is going to be your gathering, your transporting, storage, treating. Downstream, which is mostly kind of refining and chemicals, and then you have your oil field services, and these can really be a wide array of services. There's a few listed here, but there's companies that manufacture parts and equipment for the industry, that do all sorts of things. So the next slide here is just an illustration of the previous slide, just kind of showing you which activities fall into the different segments. So here we have some examples of products made with petroleum. I think, a lot of people probably underestimate how many things we use on a day-to-day basis are actually that are made with petroleum products. This list here is really a tiny fraction of the items that are made with some type of a petroleum product. I read a 2020 study that showed that gasoline makes up only 45% of the U.S. petroleum consumption. So what that means is that, in the future, even if electric cars were to replace the majority of our gasoline-burning vehicles, that we would still need petroleum products for the other 55% of our U.S. petroleum consumption. And for that, percentage, currently there's no scalable substitute. So, I think that's just kind of evidence that, the industry is not going anywhere anytime soon. There's still great need for these products. So the majority of the accounting concepts and calculations that we're going to go over today are going to be geared towards the upstream space, because that's just kind of where those technical accounting concepts reside. So I just want to walk you through kind of the phases of that, the upstream space real quick. So, really it starts out with your preliminary exploration activity. That's going to be your 3D, 4D seismic studies, exploring assets to, try to discover, economic reserves. And once you kind of analyze the seismic data, then you kind of begin the leasing phase. And so this is, going out to people that actually own the surface land and the mineral rights. Could be individuals, could be estates that have been passed down, through families, and negotiating a lease agreement, right, to obtain access to be able to drill and access those minerals. And so normally in these lease agreements, there's going to be a lease bonus that's paid to the mineral right owner. It's usually, per acre. And then they also will usually have a royalty that the mineral right owner will receive once they begin producing on the lease. So the next phase is exploring the leased property. So drilling an exploratory well and doing further analysis. And that kind of leads into evaluating and completing, testing that there's sufficient reserves to begin developing the property. Once sufficient reserves have been found and the property is deemed economic, companies will begin drilling additional wells and installing surface equipment. And then they begin, producing the property. So, selling the separated oil and natural gas on an economic timetable. And then the last phase of the E&P, or the upstream space, is the plug and abandoning of the property. So this literally means plugging and sealing the wellbore below the surface and removing any equipment to really, restore the property to its original state before any of the activity began. And this is done once a well reaches its economic limit And one thing I would point out on that is, a well's economic limit could be anywhere from 2 to 3 years up to 50, 60 years, kind of depending on the nature of the well. So this slide here kind of lists out some of the risks that the upstream space is exposed to. I'm sure if you have some public E&P companies, you've seen these listed in their risk factors. I would say that some of these can have a greater impact on international companies and offshore drilling companies. But nonetheless, these are things that you have to consider from year to year, the impact on your company. Disasters and pandemics. Obviously, we've seen what COVID has done to the industry over the last couple of years, the impact it's had. Weather, obviously, that's always a big issue. I would say, for offshore, it's an even bigger issue when there's a hurricane or something like that coming in. They have to, evacuate their rigs and make sure their people are safe. Politics, obviously, companies need to stay informed on the agenda of the current president and the administration and how they regulate the industry, no matter what country they're operating in, and whether the administration is kind of pro energy or anti. OPEC, obviously, we've heard the term OPEC. That stands for the Organization of Petroleum Exporting Countries. OPEC's been around for 60 plus years, and they at times have been able to kind of manipulate pricing in the industry, because what I think a lot of people probably don't realize, you hear the names of these big companies that you see listed here, like Exxon, Chevron, BP, Shell, but realistically, these companies control probably less than 10% of the world's oil reserves. These government-sponsored national oil companies, they control around 80% of the global oil reserves. So that's why they're able to kind of manipulate things by increasing and decreasing supply. Next one listed here, just war. Obviously, when there's conflict in the Middle East, we've seen what that can do to the supply chain globally, and what the volatile price environment that can create. And then drilling risk. This is one you have to kind of think about. There's been technological advancements in every industry, and as well as oil and gas, and they're drilling well bores now that are 30, 40,000 feet. They're drilling what they call lateral legs that are 2 miles long, and so with that, there's more pressure and safety issues when you're drilling down in these more remote areas. So that's something else to consider as a risk. So the next slide here are just some common oil and gas acronyms. I would say this is something that's really unique to the industry. There's a lot of acronyms in the oil and gas industry. A lot of these on the screen are more so measurements of how they measure oil, natural gas liquids. A few I would point out that'll probably come up in some of the later presentations. D&C, which stands for drilling and completion. So these are the cost incurred to drill and complete a well. And you may see this acronym even in a company's trial balance of accounts. They may have it listed as tangible or intangible D&C. So that's what that stands for. DSU, that's drill spacing unit. So that's talking about the distance between well pads, and it's kind of dictated by where they're drilling. JIB, that's one you're going to hear probably a lot today. So that's a joint interest billing. And that's just, a company that operates wells that's not responsible for all of the cost. They will send out a joint interest billing to their partners to recoup the cost, whether it be capital or operating cost, for their partner share. LOE is lease operating expense. So this is one you'll hear a lot today as well. Once a well comes online and is producing economically, then these are the costs that get taken to the income statement as just operating costs. And then at the bottom, you'll see P&A, or plug and abandon well. So we kind of talked about that one. on a previous slide, and we'll get into that more in the ARO section and how the P&A cost estimate, factors into that ARO calculation. But P&A is also an acronym that you'll hear a lot in the industry. So this slide here is kind of listed out the reserve categories, and again, you're going to hear these referred to a lot today throughout the presentations. And the presenters will get into this more in detail on how the different reserve categories factor into the depletion and impairment calculations, depending on the accounting method that the company follows, whether it be full cost or successful efforts. So don't need to memorize these, just trying to kind of get a general understanding of what they mean. So proved, developed, producing, or PDP reserves. So these are economically recoverable with 90% certainty and are usually in the process of being produced. PDNP, these are reserves that are usually behind pipe or shut in currently, but that can be accessed with relatively minor cost, and they're also subject to the 90% certainty criteria. You may actually hear these referred to as PBP, which is proved behind pipe, or PSI, proved shut in. There's several different acronyms they use for the reserves in this category. Proved undeveloped, that's kind of what the title states. It's reserves that are expected to be recovered from either new wells on undrilled acreage or from existing wells where there's going to be some major expenditures, so it's generally undeveloped properties, but they still have the 90% certainty. And then probable reserves, so these are going to be economically recoverable with 50% probability, and then possible reserves are going to be economically recoverable with 10% probability. I think it's just good, when you talk to your clients or reserve engineers or people in their operations group, and they refer to 1P or 2P or 3P reserves to kind of understand what they're talking about and which reserve categories fall into those buckets. So
I'm going to talk about the exploration process now. So there's a few things listed here: the geological and geophysical studies, geophysical surveys. This is kind of the research and studies that go on before you get into the drilling stage, right? You want to make sure there's oil and gas underneath in the ground where you're going to drill. So these are some techniques that they use to try and validate, get information about what's below the surface. And, in the picture here, there's an example of a seismic study where the truck here would kind of generate an acoustic sound signal or a seismic signal that's transmitted into the Earth's surface, which would then reflect off the various geological layers down there and provide, information and data to the reserve engineers that they can use to kind of make their decision right on whether they want to drill, whether they see economic quantities of oil and gas beneath the surface that would, they would want to drill. Once they make that decision, they'd enter into a lease agreement to lease minerals from the mineral rights owner. You'd then get into kind of drilling exploratory wells, where you'd go and explore further whether there's, economic quantities down there. They can be referred to as exploratory stratigraphic test wells, and if you're offshore, it can also be referred to as a appraisal well bore. And these are just used to run tests, build-up tests, stem tests, various other tests. The idea being, we're kind of exploring to see if there's economic quantities of oil and gas here beneath the surface, right? Okay, and this next slide talks about the drilling process. So once you actually have made the decision to drill, right, you'll have some initial site development to get the site ready for drilling. Then you'll have the actual drilling process where you have a drilling rig used to drill, into the rock formation. This can be conventional vertical drilling or horizontal drilling. The next slide, we'll kind of get into that a little bit further. Completion is just refers to the work performed, the installation of permanent equipment for production of oil and gas from a recently drilled well. So this is just, the final stage is completing the well. And then production just refers to when the well begins to produce oil and gas. So the initial production stage, and from then it's kind of considered a producing well. So this is a depiction of some how that would work. So on the far left, you kind of have a traditional vertical well, right, where it just goes straight down, and then to the right of that, you'll see it kind of, there's a horizontal one where they can kind of shift directions when they hit their target when they hit the gas-rich shale. So you'll see on the top left, that's a conventional non-associated gas, and so that's a natural gas that's not in contact with crude oil. Whereas on the right side, you have more conventional associated gas. So that's natural gas occurring in the form of like a gas cap that overlies an oil zone. So just kind of technical stuff, but just something to be aware of. The tight sand gas, that's just a rock formation when there's just small, densely packed particles, so they're just tight formations. But yeah, no, this is just kind of an illustration of conventional and non-conventional, and the vertical drilling versus horizontal. The types of oil and gas interests, so you have royalty interest and working interest. Royalty interest is kind of considered, I would consider that just kind of a revenue only. So you're just going to get a share of the production, so you don't share in any of the costs. Whereas the working interest, you're going to share in the costs, and then after the royalties are paid, you would also share in the revenues. So royalty is going to be, like I said, revenue only. Working interest, you're going to have to share in the costs as well. But this is just the interest in the oil and gas wells that owners can have, and how they share in the production and or costs that are associated with each individual well. It's worth noting that these can be broken up into many owners. So each well can have hundreds of different owners, and they can be different between the royalty and the working interest. So you'll when you get into that in testing, you'll see that we have to do a lot with the decks that kind of determine the interest in the well. So you'll see a lot of this when it comes to royalty interest and working interest. In terms of the products produced, obviously you have the oil and natural gas. Those are obviously the well-known ones, but salt water is also a frequent byproduct of oil and gas production. So it's a waste item, so it has to be disposed of in a safe manner. And customarily, you will see that it's gathered and re-injected back into a subsurface formation. Oil and natural gas, obviously, we're aware of those. Natural gas liquids, generally that represents hydrocarbons, which are extracted from wet natural gas, and they can become liquid under various combinations of increased pressure and lower temperature. That consists primarily of ethane, propane, butane, and natural gasolines. So that's kind of the products that you generally see produced from oil and gas wells. Oil price history. So as you can see, very volatile. Late 2000s, you had a big spike, oil going almost up to 130 range, and then it crashes back down to sub 50 very shortly thereafter. Here more recently, you saw with COVID, oil going down in the 20s, and I think it even went negative one day. So very volatile, just something to be aware of, that you're never too far away from a potential impairment trigger when it comes to your oil and gas properties. You just got to be aware of the volatility that's associated with the oil and gas commodities. So that's really just depicting that here. Same thing with gas. Similar to oil, you had kind of a good times in the early 2000s, and that kind of tailored off. in 2010 and kind of trailed beneath that ever since. Again, here recently with COVID, you saw a downtick, but actually gas has actually done pretty well here in the immediate term, or in the recent past here in the last year or so. It's back up above levels we haven't seen in close to a decade, so it's back in a positive place, whereas a lot of oil and gas companies that were gas heavy over the last decade really struggled to survive. Now there's pricing that really supports a healthy environment for them. These are the major U.S. plays. So, a lot of our clients are going to be here in Texas. We had most of the production coming out of Texas, out of the Permian and Eagle Ford. Permian's out in West Texas with the Delaware. Eagle Ford's down in kind of South Texas. A good chunk of our clients are going to be in one of those two basins, but also, we have various activity throughout the other ones. Up in the north, you have the Bakken. Going south from there, you have the Green River, Piceance Basin, and then in the northeast, you have in the Appalachian, Marcellus, and various others. But, this kind of just depicts where all the major plays are. But like I said, I think a big chunk of us will be in the Permian and Eagle Ford for the most part. So getting into the accounting methods, I'm not going to touch too much on this because there's a whole section on it, but just kind of high level, there's two different accounting methods that account for oil and gas properties. There's successful efforts and then full cost. So under successful efforts, you capitalize only the costs that are directly related to the specific oil and gas reserves, and only when those results are positive and economic minerals are located. So there's kind of a success versus failure concept there, where successful wells and development costs are capitalized, and the costs that cannot be linked directly to economic reserves, along with unsuccessful exploratory costs are expense. That's going to differ from the full cost method, where all property acquisition, exploration, development costs, including dry holes, are capitalized as oil and gas properties, and then those are amortized on a country-by-country basis. So again, I'm not going to get into that in great detail. There's a whole section that kind of goes into that in more detail. Under the impairment, those models are different too between those two methods. Full cost uses this what they call a ceiling test, which uses a historical pricing versus successful efforts uses a two-step impairment test using forward-looking pricing. But again, that'll be looked at in more detail in a subsequent presentation. Common metrics, reserves. Nick talked a little bit on that. That refers to the oil and gas reserves in the ground. EBITDAX is earnings before interest, taxes, depletion, amortization. That's very common in our public filers. Almost all of them use EBITDAX as a reference in their 10K in their earnings releases. Production per day refers to the oil and gas production per day. You see that in a lot of presentations as well, what they produce per day. And then LOE per BOE. That's a very common one, and that's very common for us as auditors to use as well. That refers to lease operating expense per barrel of oil equivalent. So the cost for each barrel of oil they produce is very relevant in our testing. And with that concludes kind of the intro.
All right, so like I mentioned, we'll talk about full cost versus successful efforts, kind of an overview of it. We will dive a little bit deeper into the property-related cost, as well as the accounting for acquisition, disposal, and other issues. We will not touch base a lot on the depletion and impairment, as that will be covered in detail in the DD&A and impairment actual presentation. So just kind of keep that in mind. All right. The basic differences, and this is just high level, under full cost, all of the properties and fields lose their identity, and they're included in the full cost pool. And that full cost pool is based on by country. So any of our clients that might have just properties in the U.S., they only have one full cost pool. It is a challenge because they lose their identity. It is more difficult to identify the individual property in which really costs you. So that is a challenge that the companies face as well as we face as we go through our audit procedures. Under successful efforts, each property or field is considered its own cost pool, and so the record keeping needs to take place at a more disaggregated level, and so at the property level, and it's much more detailed, and we'll kind of see in the pros and cons later how it can be a little bit more time consuming. However, there are benefits of the fact that the detail is actually there and available. All right. For the full costs, all costs associated with the property acquisition, exploration, and development activities should be capitalized regardless of outcome of drilling. This is a big distinction between full costs and successful efforts, in which successful efforts, as you can see on here, that any dry hole cost, exploration that don't actually result in proved production, those would be expensed when they are actually incurred. So this full cost, most costs are capitalized. The largest expense is DD&A, depreciation, depletion, and amortization. And you should not see any exploration or dry hole costs on the income statement because they're included in the full cost pool and subject to depletion over time. And then both full cost and successful efforts have lease operating expenses included on the income statement. So, and we'll go into a little bit detail. This is a nice key cheat sheet. And again, this is an easy, quick reference of which is capitalized and which is expensed, especially with successful efforts. As you can see, there's a difference between property delay, rental, and geological and geophysical cost, as well as the cost of drilling an unsuccessful exploratory well. So those are the key differences between successful efforts and full cost. All right. To go a little bit more in depth, some of the pros of successful efforts is that, and I mentioned this a little bit ago, but it's easier to value a group of assets in the event of an acquisition or sale. So you already have the information disaggregated to the property level. So whenever a company does determine that they want to go and get and sell the properties, it's easier for them to determine the costs that have already been incurred to date for that property. This is very beneficial for companies that actively purchase and sell properties, as all the information is readily available and it hasn't lost its identity in the full cost pool as with full cost. This is recommended by the SEC, IFRS, and FASB. Actually, under IFRS, their accounting for oil and gas is very, very similar to successful efforts. Full cost is not a recognized method of accounting under IFRS. So another pro is that it forces the company to track the revenues and expenses by property, and it just provides a better internal analysis, which can be utilized, to determine how the properties are doing and whatnot. Additionally, the impairment in situations where there is an impairment, they can be limited to a specific property or field rather than the entire cost pool. Also, I think one of the cons would be the higher administrative cost. As you can imagine, including all of this information for individual wells can be very cumbersome for companies. And so there is an additional level of administration in as it relates to tracking these costs, as well as the associated depletion and impairment, on these field bases rather than the full cost pool. And then also whenever the information is being gathered for the accounting department, it does require additional time and additional disclosures in the financial statements. So those are some cons for the successful efforts. For full cost, some of the biggest pros are it's just one depletion and impairment calculation performed. It makes it a little bit easier and cleaner because all of the costs lose their identity by property, so it's all in one full cost pool. And so this is favorable for small companies as it gives it a positive outlook of income, and also just easier to keep track of. And then it also encourages smaller companies to be more aggressive in exploration. As I mentioned before, for a dry hole cost, those are expensed under successful efforts. And so a smaller company that might not want those big hits to the income statement because they're expensed, using full cost allows them to capitalize them and then deplete them over the life of the full cost pool. Some of the cons would be that it's harder to value a group of assets. And so if you have, if a company is using full cost and they're wanting to sell off a portion of their assets, it may be more difficult for them to find the information related to those to actually determine the amount of cost already incurred. And then also earnings may be inflated from an investor's perspective, particularly as it relates to exploratory wells or items that wouldn't otherwise not have already hit the income statement. And so it's a delayed hit to the income statement on if there are drilling several or exploratory or unsuccessful dry holes. All right, so this is a pretty intense chart, and again, these will be provided to everybody after the presentations today, but we just wanted to go ahead and give you a nice flow of different costs that you may encounter during, while we're looking at these, companies' CapEx cost. Some of them for under full cost, as you can see, anything that is incurred prior to the development and production of the well, including acquisition, exploration, and development costs, are all capitalized on a countrywide basis and then included in the full cost pool. And then there are some temporarily excluded costs from amortization, which included the direct costs related to acquisition and evaluation of unimproved properties. So those are the ones that are excluded from the depletion base, and that'll be discussed a little bit more in detail later on in the DD&A and impairment section. But just keep, as this chart is showing, that most of these costs are capitalized until you get to the production phase, and then as with successful efforts, full cost production costs, LOE, are expensed, so they hit the income statement in the period that they're incurred. All right. Okay, and over here, this one is a similar chart, but now for successful efforts. And you can probably see the difference between the two, in which the acquisition costs are capitalized. However, when you get into this exploration cost, it depends on whether or not they're successful and if they need to be expensed immediately. So this is one of those key factors that whenever we're looking, or a company is working through exploration wells, it's important to know the success of it and to know whether or not those costs should be capitalized or they should be expensed based on if they're a dry hole or not. Another thing to keep in mind that, if you have a full cost company, we shouldn't see dry hole costs on the income statement. So if you see that, that's definitely a question that we want to ask as to why there's dry hole cost included on a full cost company. And then from a successful efforts, keep in mind that we want to make sure that any costs that were incurred were successful, and that they are properly and capitalized or put on the income statement based off of the success of them.
So we're just going to go over the workover clause. We're going to figure out what it is and just kind of understand the reasons of it, capitalization, how we expense it, auditing, how we will handle that. So workover costs, it's any kind of intervention involving invasive techniques, which involves the pulling and replacement of a completion. So any type of like remedial operations to a completed well to restore, maintain, or improve the well's production, that's going to be a workover. This can include like the removal of any sand or paraffin buildup, and really anything that's just going to help improve that well. So generally it is an expensive exercise, and by the nature of the cost, it is a production cost, and it may be a planned or unplanned event. Obviously things do come up where they were not expecting it, but also we have companies that will that do plan on shutting down a well to work on it, especially if like maybe prices are low at the point, they'll just shut it down to work on it so they can increase the reserves. So reasons for a workover, changing reservoir conditions leading to lower output. Downhole components may have been damaged or corroded, so they're just going to fix it. And then also any like innovative new technologies are available that may extend the life of the well. So I know I have a lot of companies that have doing a lot of horizontal drilling, which just helps extend the life of the well. So next, for successful efforts, the main difference between successful efforts and full cost, successful efforts will capitalize the workover cost that will increase like the future of the reserves, whereas full cost will capitalize everything. Only successful efforts will you capitalize the workovers only if it increases like production or the future of the reserves. So this like entering a new zone through horizontal drilling, re-entering a previously shut-in well to perform a recompletion, and also saltwater disposal well drilled in the field. And then you will expense the LOE. So those are costs incurred to maintain the well or prevent it from causing damage to other wells or the environment. So as you can see, the difference is either the workovers will increase the reserves, or just to help maintain the well or prevent it from causing damage. We have to understand the reason the cost was incurred. So we will, supplier invoices often do not provide a clear answer, and invoices can be a lot of pages and very confusing. So we will also ask probably for the AFE, which is the authorization for expenditure. We can look at like LOS, lease of, consider the production trends where we can look at the LOS to see if volumes have increased or decreased before or after their workover. And then what is the business case for incurring the added cost, understanding the nature of the production at the location, and is this a lease operating cost? So, like for full cost for successful efforts as a workover will be on proved reserves, generally no differences arise. So that's just to what we will ask for and how we will audit those workover costs to make sure that they either are capitalized incorrectly or that it should be shown as an expense. This is just an example of an AFE, authorization for expenditure. They will not all look like this. This one looks pretty clean. We have the location, we actually have a purpose, and it says to conduct exploration activities for possible leasing and subsequent drilling and development. We have estimated cost, actual cost, and then the variance. And then we just have an approval down here showing that they did approve it. So next we will go over property costs, acquisition costs, exploration, development, and production costs. So for acquisition costs, those are costs to purchase, lease, or otherwise acquire property and mineral rights. So lease bonuses, options to purchase or lease properties, broker fees, recording costs, legal expenses, and other lease costs. Initially, they will capitalize these costs for both full and successful efforts, and then acquisition costs are incurred before evaluation of reserves, so before they figure out if it is approved reserve or unproved. And then after the exploration and determination of reserves, it could be expense. So if after they figure out that it's an unproved reserve, then under successful efforts, they will expense that acquisition cost. So differences based on accounting approach for acquisition costs. So for full cost companies, once the cost is identified as being an acquisition cost, it is classified as an asset in the cost pool. The costs are not identified as related to any individual property because under full cost, they are all under the same pool. And then there's no change in the nature of the cost, even if the reserves are not identified. So even if they do the exploratory well or the exploration and they realize it is unproved reserves, they will still be capitalized. And so then under successful efforts, the cost are allocated to each individual property. And then the determination, there are no proved reserves at the exploration phase. The results in the reversal of the asset previously recognized. So after the exploration phase, if they realize there's no proved reserves, they will reverse it to an expense. And then it will expense all such acquisition costs for the particular property. So to audit acquisition costs, we need to identify all unevaluated properties and identify the key costs included for the individual properties. You'll ask your client for a roll forward of the oil and gas properties for the year. We will make sure that this listing is complete. We will also review current year unevaluated properties to prior year listing and just ensure that make sure if there's any changes that we need to ask about, just ask the client. Acquisition costs will tend to relate to unevaluated properties. As most acquisitions, they do purchase properties that they're just not sure if it's going to be proved or unproved developments. Then they'll review the legal and brokerage cost invoices and ensure the costs are related to the appropriate properties. And then we expect costs incurred at this stage are going to be intangible drilling costs, which we will get into the difference here in a second. So for exploratory cost, identifying areas that may contain oil and gas reserves. So they're incurred before a property is acquired or after acquisition. So it could be either. Includes review of the geographical and geophysical data to see if they do contain reserves or not. Companies may purchase such data or perform such studies themselves. It's just whatever the company rather do, if they rather pay someone or do it themselves. Exploration costs include costs of carrying and retaining undeveloped properties. And dry hole costs and ad val taxes, which are property taxes, are also considered exploration costs. Now, under full cost, you will capitalize all these. Under successful efforts, you will initially capitalize these costs and expense afterwards if no proved reserves are discovered. And then you will expense all other exploratory costs. Do you want to add something?
Yeah, can you go back to the previous slide?
Oh, yeah. Okay. No.
Okay, perfect. You're good. So I just wanted to make sure that kind of really hit this idea home is whenever we're looking at the acquisition costs, I went back another slide, but whenever we're really looking at acquisition costs, and these are costs that are, used to purchase properties, it's really important to identify if there's any unevaluated properties, and then to also discuss with the client related to the allocation or how they use the cost if there's both unevaluated and evaluated properties. And so this is one of those bigger ticket items that we'll see. And I think that in 2021, and I think there was a lot of activity in the market. So we might have several clients that have acquired properties. And so this is one of the things that we want to kind of start early on and have these discussions early on. Important for us to obtain the roll forward, but also really identify within the roll forward what is related to unevaluated and what is related to proved or evaluated properties. And then because our testing procedures on those are slightly different. And so I just wanted to hit this home to make sure that everybody is aware that those are the questions that we need to kind of start asking early on in the stage of the audit. But then also just going back to this where, have the exploratory costs. These are ones that are, the company will incur these costs. And a lot of times this is done before the property is acquired. And sometimes it is after the acquisition and it incurs a lot of costs. So in a full cost, you'll capitalize the entire thing. However, in a successful efforts, if anything that is done after and no proved reserves are discovered, it needs to be expensed, and then any other exploratory costs are expensed. And so that's one of those key things in the industry and whatnot that we'll kind of see very frequently. So
other exploratory costs, this includes costs of carrying and retaining undeveloped properties such as delay rentals, property taxes, defense costs, shut-in royalties. So for delay rentals, amounts are paid to a lessor after the payment of any bonus for the privilege of deferring the commencement of a well on the lease. And then also for topographical and geophysical studies and salaries related to those studies. So for G&G, costs are associated with the process or the study which seeks surface and subterranean indication of earth structure or formations where as shown mineral deposits may exist. So these are just other costs related to exploratory that you can see. So the identification of a dry hole in a successful efforts company. So once it's determined that there are no proved reserves, all the costs incurred to date are expensed. You will reverse it if it was capitalized before. So for dry hole determination can be at the acquisition, exploration, or development phase. Any of those phases, it can be found that it's a dry hole. And then for the lack of reserves for the particular well are not an indicator for all wells in the field. So just because that one does not have any reserves does not mean the one like across the way doesn't have reserves. And then the allocation of acquisition and exploration costs incurred on the field level and allocated to individual properties. Just that successful efforts, they're all allocated to individual properties. So, and then identifying dry holes that are incorrectly capitalized. Is there a listing of dry holes available from the client? You can definitely ask. What happened to wells listed in the prior year as exploratory in nature? So whenever you know in prior year that they were looking at certain wells, you definitely want to find out if they did have reserves or not, and then ensure that it was either capitalized or expensed correctly. For unevaluated properties in the prior year that no longer appear to exist, you definitely want to question that, like what happened to those properties on the listing. And then comparing the reserve report classification to well listings, just to ensure that nothing changed. And if it did, you definitely want to ask the client about it.
For the property cost or the development well cost, I think that one of those things that we want to point out is that the development phase is to obtain access to proved reserves. So initially a company will, a lot of times they'll acquire undeveloped acreage, and so they develop the rights to drill and complete a well. And then after that, once they have the rights to complete a drill well, they decide whether or not they wanted to drill and develop a well. So these costs to develop the properties includes providing facilities to extract, store, and treat the commodity production facilities, the storage tanks, processing facilities, anything that is essentially needed to get the product from the ground to the end user. So for the company. So this, as I mentioned, this includes the facilities for extracting and whatnot. So then under that full cost and successful efforts, the costs associated with the development activities should be capitalized whether or not the cost directly result in the finding or development approved reserves. And a lot of times this is the cost in the area as well. So, but if this development is related to dry hole, and then for it related to dry hole, cost should be expensed. All right. Now we also want to go a little bit over tangible and intangible drilling costs.
So for tangible costs are just costs of assets that in themselves have a salvage value, where intangible costs do not have that salvage value. So, I mean, anything that is physical is a tangible cost, where any, like day rates and stuff will be intangible. Okay. Now for production costs, so those are going to be costs associated with activities that involve bringing oil and gas to the surface. No matter what, there's no difference between full costs and successful efforts. That is always expensed. So it's also gathering, storage, processing, and treatment costs in the field. And then it also refers to costs incurred to operate and maintain the proved reserves. So labor to operate the wells, repairs and maintenance, materials and supplies, ad val taxes, and insurance on those properties, as well as severance and production taxes.
Okay, and just to add a little bit more. So from this, the production cost, this is once the well has been developed. So like I mentioned, they start with acreage and then they drill and complete the well. And once the well has been developed and put into production, then costs incurred to like involved with gathering, storage, processing, and etc. are expense. And so that's really the key point, is when the well starts producing, that's when it transitions to where it's all production costs going forward. And then if any other incremental significant costs are incurred, such as workover, then we go back to that discussion whether or not it should be capitalized or not based off of the cost itself. But just kind of keep in mind that once a well starts producing, that's when it goes from a development cost into a production cost.
So now auditing considerations for property cost. So defining an asset compared to an expense. So an asset is a resource under the control of the company. It's also from which future economic benefits are expected to arise. So the cost can be either an asset or an expense for property cost. Both transactions are a debit entry. The classification is not always clear with the successful efforts company, which is where we will need to dig in, talk to the client. And then significant risk of understatement of expenses and overstatement of assets for incorrect classification. Understanding the client is a key issue to understanding the nature of the cost. And then you can always consult with your partner, manager, or senior if you're not sure, and we will always be glad to help you.
And then just another quick thing. Sorry. So I just want to kind of point to this, back to this understatement of expense and overstatement of assets for incorrect classifications. This is one of those things that the better you understand your client and where they are and where the wells that they have are on the on their well useful life would be an indicator, and then how much of the costs are related to workovers versus capitalized from a development standpoint. So whenever you're doing a thorough risk assessment, just keep that in mind and have that be a very key discussion on whether or not it's a larger or an elevated risk or a moderate risk related to the classification of expenses versus asset addition for those workover costs.
Okay, so for general auditing, So for general auditing issues related to the property cost, so operated properties. So we have operated properties and then non-op. So for operated properties, the client is the operator and record and receives the vendor invoices for payment. And we got to understand the approval process and how coding of invoices are done. Invoices will mostly be 8/8, which means 100%. They apply the appropriate. We got to make sure they apply the appropriate working interest to the total invoice amount when testing, which we test that deck like crazy. So then changes in the working interest may occur on the same property. It can occur at the after the exploration or at any point, as long as it's agreed upon both parties. And then we'll review legal agreements and correspondence to ensure changes to working interests are appropriately applied. So we will test the deck to ensure that the working interest is correct, and we will ask for those legal agreements and correspondence to just make sure that they are correct, because if your deck is wrong, you have a lot more issues. And then operator issues a joint interest billing to other parties for recovery. So they will pay the full expense, the operators, and then they will bill the other partners or owners of the well for their part of the expense. So be aware of related party operators with similar corporate name identity. We will just need to identify those that are related parties. Third-party documentation, invoicing are always more reliable, so we will always ask for that. And then we will ask for the original invoice for review to make sure that there are no related parties. For non-operated parties, so those are where the operator will provide the JIB, so the non-op will receive the invoice, the JIB. So we review the JIB and supporting documentation. Is it at 8/8 or for a working percentage? So just ensure the working interest applied appropriate based on the testing performed on the deck. Has the JIB been approved? Has JIB been approved by all relevant individuals at the client? So we need to understand the approval process and ensure costs are related to the well that we are testing. And then sometimes JIBs do not reflect the appropriate coding. We will need to understand the nature of the expenditure when performing our test work. And just ensure, is it adequate supporting documentation available to support the allocation of the cost between acquisition, exploration, and development cost?
Okay, and just and keep in mind that as a general rule, the company may be operator for some properties and non-operator for other properties. So the type of support we get will vary sometime even within the client. But for the operated properties, just keep in mind that like Taylor had mentioned, that they're on the 8/8 invoices, but those are ones that are key for us to make sure that we understand the nature of the cost thoroughly. And so sometimes an invoice isn't sufficient. So even if it's a production cost, and many times it's a workover, and I know we've hit this one quite a bit, but just keep in mind sometimes we need more than just the invoice when we do that. And then the same thing from the JIB standpoint. A lot of times the JIB might not be sufficient for us to really understand the cost incurred and whether or not it was appropriate coding. So additional questions may need to be arisen, and those oftentimes can go to the operations group, and they might have, back and forth discussions with the operator, or just a thorough understanding of where the property is, what the property is doing at that time period.
Thank you. All right, so this is just an example of what an entry would look like for an operator. So Rico Resources owns 50% of the Lufkin lease, and then Silver Bullet, a non-operator, owns the remaining 50% of the lease. Now, Rico receives the invoice from Oilfield International for drilling services performed for $1 million. So the following entry will be recorded by Rico. So we will record a debit for a JIB receivable, as that's what we will receive from Silver Bullet, since they will owe 50% of the working interest. We will debit the oil and gas properties for our $500,000, and then we will credit accounts payable for $1 million, because we will pay the full. They will pay the full expense, but then we will receive 50% of it back from Silver Bullet. So once the operator pays the invoice, debit accounts payable, credit cash. And then once they collect the receivable from Silver Bullet, you'll just debit cash and then credit the JIB receivable to get it off your books. Now, from the non-op perspective, same scenario, except for this is going to be on Silver Bullet side. So for Silver Bullet, they will debit oil and gas properties for $500,000 and then credit a JIB payable for $500,000, showing they owe that to the RICO Resources. And then once Silver Bullet pays the JIB, they will get rid of it, the JIB payable, by debiting it for $500,000 and then crediting cash for $500,000. So just auditing issues related to property costs. So a cash call is a prepayment made to a partner or operator. This is due to significant costs involved in the acquisition, exploration, or development phase. It requires a company to pay a cash lump sum in advance for actual costs being incurred. The initial accounting for the cash call will typically be classified as a long-term asset under prepaid drilling costs. Companies do have the tendency to record this as a current asset, so we need to be aware of that. And we may need to create a PAGI for reclassification. It will also, long-term disclosures are as a result of the nature of the cost, so we need to make sure that is included. And then just a little note, classification should be based on the nature of the asset rather than the expected time to be utilized. Utilization of the cash call. This is to reduce the prepaid drilling costs and increase oil and gas properties based on actual invoices once they're received from the vendors. We will need to understand the journal entries and kind of the flow of transactions, and the accounting treatment for these cash calls are going to be the same for both full cost and successful efforts. So just a quick cash call illustration. So once again, same scenario, RICO owns 50% of the lease, Silver Bullet owns the other 50%. RICO cash calls Silver Bullet for $1 million for just anticipated drilling costs in the next month. Silver Bullet gets the cash call statement, but Silver Bullet does not have to record the entry as they have not incurred a contractual liability just because they received that statement. In practice, you will sometimes see companies debit a prepaid and credit a payable at this stage, and this treatment is generally incorrect as nothing has been prepaid. So they do not need to create an entry until that cash is paid in full. So Silver Bullet finally pays the cash in full, so they will create the entry debit prepaid drilling costs and credit cash. And then once Silver Bullet receives the joint interest billing from RICO for drilling costs for $500,000, they will apply that against the previous cash call. So you'll debit oil and gas properties for $500,000 and then credit that prepaid drilling cost.
All right, so we're going to take a minute to talk a little bit about accounting for acquisitions and disposals. This is kind of a key thing that we've seen a lot the last few years in the industry, and particularly as the market is very active in transactions and stuff. So you likely would see some sort of acquisition or disposal activity. We work in several oil and gas companies. Our focus is to highlight both accounting and audit issues within ASC 805 and how it relates to the audits of our oil and gas clients. I am not going to go deep dive into ASC 805. I highly recommend if you're working on a company that has an acquisition during the year or if you just want some light reading, just to go and deep dive into ASC 805 to really take into consideration different pieces of it. But we're just going to really touch point on how it relates to the actual oil and gas piece of ASC 805. So ASC 805 definition of a business is a couple of years ago, they brought in the definition of a business to include an integrated set of activities and assets that is capable of being conducted and managed for the purpose of providing a return in the form of dividends, lower costs, and or other economic benefits directly related to investors or other owners, members, or participants. This is kind of key in an oil and gas company because historically, producing properties were automatically considered a business combination. However, the expanded definition includes that a screen test and whatnot, which we'll kind of go into a little bit more later. But acquiring a combination of unevaluated and evaluated properties requires more judgment and consideration in determining whether the acquisition is considered a business. If they only are acquiring unproved or unevaluated properties, so acreage, typically this does not meet the definition of a business, so that typically would be considered an asset purchase. However, just keep in mind that it can be a judgment call, particularly if a portion of it was related to evaluated properties or producing properties. And biggest key point is this is definitely one of those areas that we want to discuss early as it relates to whether or not it meets the definition of business, or it should be considered a business combination or an asset purchase. So under ASC 805, the screen is applied. So ASU 2017-01 adds an initial screen to determine if substantially all of the fair value of the gross assets acquired is concentrated in a single asset or a group of similar assets. If the screen is met, for example, if substantially all of the fair value is concentrated in a single asset or group of similar assets, the assets acquired in activities is not a business. If the screen is not met, i.e. substantially all of the fair value is not concentrated in a single asset or group of similar assets, the company must further evaluate the acquisition in the framework of ASU 2017-01 to determine if specified minimum required inputs and processes are present to be considered a business. One of the key indicators on here, going back to the screen a little bit, is that for oil and gas companies, a lot of times they'll acquire producing properties in any given field. And sometimes those assets, although there's multiple producing assets, they can sometimes be concentrated in a group of similar assets. So, for example, acquiring 20 wells in one reservoir in one field that all have similar characteristics, all are, have drilled around the same time and, have similar risks and whatnot. So those may be considered a group of similar assets, which is a key factor in this, the screen test. The screen is intended to be a practical way to identify transactions that are clearly asset acquisitions. The standard does not define substantially all. However, this term is used within our other areas of GAAP and is typically interpreted to mean approximately 90% or more. So, for example, if the company acquires unevaluated assets and has 2 or 3 producing properties, that in and of itself may not, make it meet the definition of a business, because substantially all would be the unevaluated piece. With acquisitions including proved and unproved, developed and undeveloped, properties in different geographical locations or geological formations, judgment will be required to determine if these are considered a group of similar assets. So this is key in the fact that if a company acquires multiple different properties in multiple different areas or geographical locations or just in different formations, whether or not the assets are distinct or if they are considered a group of similar assets. And again, there's a lot of judgment involved in this, and so if you're coming across this, consult early and to get through this, and ensure also that your company understands and that your client is identifying the risks and related properties. All right, under some of the key issues to be concluded upon We want to make sure that we identify the acquirer. It's important to determine the acquisition date. This is the date that the acquirer gains control over the acquiree, and that's the closing date. And a lot of times, if you're reading a purchase and sale agreement or a closing statement, there will be the closing date on there. That is the date that the acquirer legally transfers consideration, and the acquiree assumes the asset and the liabilities associated with it. This is when they recognize and measure the assets and liabilities assumed. This is sometimes different, or this often is different from the effective date, which is the date the acquisition is in force. This impacts the total purchase price of the acquisition, as purchase price adjustments are made to compensate the buyer or seller for revenues and expenses incurred from the effective date through the closing date. So generally, when you see a purchase and sale agreement, you'll see that there is an effective date in which the company will include the revenues and expenses from the effective date through the close date. And it's important to realize when those dates are and what costs are incurred prior to effective date, between, and then after effective date and before closing date, and then also what costs are incurred at closing and then after. Because the cost and revenues and whatnot, which are incurred, are treated differently based off the date in which that they fall into. We recognize and measure identifiable assets acquired, liabilities assumed, and non-controlling interest in the acquiree. As of the acquisition date, the acquirer shall recognize separately from goodwill the identifiable assets acquired, the liabilities assumed, and any non-controlling interest in the acquiree. That's as of the acquisition date or close date. To qualify for recognition as part of applying the acquisition method, the identifiable assets acquired and liabilities assumed must meet the definitions of assets and liabilities at the acquisition date. So this will be included in the purchase and sale agreement, where where it will be listed the specific assets to be acquired, specific liabilities that are included, and any other important indicators that are included in the purchase and sale agreement. Another point to be considered, just these that are included, and any other important indicators that are included in the purchase and sale agreement. Another point to be considered, just when your company or your client is producing properties, keep in mind the liabilities assumed would also include asset retirement obligations and whatnot. But you keep that in mind also, because that's also, it would be an addition to the assets. But just those are little things you want to keep in mind. But from there, just make sure that all of the identifiable assets are included at acquisition date, and then properly considered in relation to the assets and the screen test, and whether or not it qualifies as the definition of a business combination. All right. So another key issue is that you want to recognize and measure identifiable assets acquired, liabilities assumed, and non-controlling interest in the acquiree, whereas the acquirer shall measure the identifiable assets acquired and any non-controlling interest at the acquisition date fair values. So this is a key factor, that if it is determined that the acquisition is a business combination, the acquisition date fair value should be taken into consideration. And then from there, any purchase price adjustments, specifically as it relates to revenue and or expenses incurred from the effective date to the close date or the acquisition date, are then to be considered as purchase price adjustments. This is why it's important early on to identify if the assets themselves pass the screen test and whether or not they're considered a group of similar assets, and therefore is an asset acquisition. Therefore, the cost paid is the cost that's added to the balance sheet, versus under a business combination, everything would need to be fair valued. And so that can be a cumbersome time-intensive process to ensure that fair value is determined, particularly as it relates to multiple different assets and multiple different areas. And if there's other significant liabilities assumed, or other items included in the business combination. So when going through this process, just take a minute early on and discuss with your team, with the partner, to make sure that any areas, any things that we might need, which may include the use of our valuation experts, the need for the company to do a third-party evaluation, that those are identified early on, to save a lot of headache and throughout the process. Another thing to keep in mind is that you would want to recognize and measure goodwill or gain from a bargain purchase. There is a likelihood that goodwill will immediately be impaired due to the nature of oil and gas assets. Oftentimes, because oil and gas companies are doing transactions on a fairly frequent basis, these items are to be, evaluated, and they're bought and sold oftentimes at fair value. So we normally don't see as a lot of bargain purchase or goodwill in oil and gas, but that doesn't mean that it never happens. And especially in situations where a company may be going under, maybe going bankrupt, and maybe selling their assets at, a discounted rate or a discounted price just to get them off their books or whatnot. So keep that in mind. But that's just not something we see too often. But this is why it's very important to get that fair value, if it's determined that it is a business combination, to get that fair value early on to ensure that we properly consider any goodwill recognized. All right. Going back a little bit into determining the fair value, that the fair value of assets purchased at the closing date or acquisition date compared to the purchase price. So you're going to want to make sure that any unevaluated and evaluated properties are separately evaluated for review, and then what type of valuation is necessary. So unproved costs considered internal valuation basis, and just understand the nature, and then also obtain the value of or the reserve data for proved reserves. And then, maybe there's probables included in there that also may be valued, but, adjusted, risk adjusted or whatnot. But just keep in mind that the probables and possible reserves may have value, but included as unproved. So oftentimes it's not cut and dry. These are things that when you get into this situation, have those discussions with the engagement team, within the engagement team, and then with any evaluation experts. And just to keep in mind that it might not be clean cut. The reserve report should be on the date of closing of the transaction. So this is oftentimes to determine fair value. It's based on management's best estimate of future value of acquired properties. So, and you guys are going to learn a little bit more about the reserve reports later today. But the reserve report is essentially the future cash flows. And so the discounted to today's date would be the basis for the fair value. Pricing is in the reserve report is not SEC pricing, which is used in the depletion calculation, but is rather the management's best estimate. So this is an indicator of true fair value. And then also for the discounting, PV10 is not likely to equate to fair value. So you'll have companies that, maybe use PV9, PV 9.5, PV10 sometimes, but PV11, it just depends on, the other acquisitions in the area or whatnot. So these are inputs that we need to critically evaluate under business combination to make sure that it's properly evaluated and for fair value. So it should be using strip-based future pricing for expected life of the well. This would be included in the reserve report. And then also adjustments to strip pricing should be consistent with the differentials tested during the audit. This is something that, they might not be able to adjust the strip pricing, but, the differential, that might be more of the company's individual assessment of the acquirers or acquiree properties. Also, ensure there's a review of the working interest utilized in the calculation. This can affect the fair value for both for NRI and working interest. And then any assumptions related to future development costs and operating costs, to make sure that that's consistent with historical costs and current trends. So these are things that we want to evaluate when we test the reserve report on the date of the transaction, because oftentimes, even if we use our valuation group to help us value for a business combination, it's important that we do the testing on the reserve report, because that's what they're expecting. So we need to make sure that we include that testing in the business combination testing. Okay, so go a little bit, shift out of acquisitions, and we're going to talk a little bit about disposals. I think from here, one of the biggest things is to determine whether the disposal represents a discontinued operation or normal disposal. So a lot of times companies will, buy and sell properties either in groups of properties, or sometimes they just want to, if they have a lower producing couple of properties, they just want to, get them off of their books. And there's various reasons why a company will dispose of properties. But it's important to determine if the sale is at well, field, or other grouping. And then also under full cost, it's easier as normally discontinued to exit from the entire country. That it's easier to determine if it's a discontinued operation, because it would literally have to be the entire country that they'd exit out of to be a discontinued operation. A significance calculation is used under full cost, and so that's to determine whether a gain or loss is required recorded on the income statement. This is key, as under full cost is all the assets have historically lost their identity. So we do a significant calculation to determine if there's a significant impact, to determine if there's gain or loss. And then also consider the potential effects on the DD&A calculation. So if there's a significant change in depletion base or the depletion rate, to determine if it's a significant. A couple of key things to keep in mind, that there are some SEC requirements on the acquisition disposals. If it is determined to be significant, they must file a Form 8K for any item considered to be significant. And then Rule 305 and significant acquisitions. And then also Article 11 pro forma financial statements. So if you're working on an SEC on an issuer and they're doing an acquisition or disposal, keep these things in mind, because there might be additional disclosures. And many of these might not be at your end. So just keep that in mind as we go through that. All right, so significant disposals and full cost companies. A couple key things to keep in mind in determining significance. Because each property in the full cost pool loses its separate identity, the disposal of a portion of the assets can't be identified. And that, so all of the costs, like as discussed before, would include all of the assets in an entire country. And so unless the disposal represents a significant portion of the assets, there's no gain or loss realized on the disposal of the assets. So it's simply just if they say they have 50 million in oil and gas properties and they sell, 200,000, it would just be credit 200,000 to oil and gas properties, and it would just be removed from the full cost pool. And then of course, then the cash received for it. So credit or debit cash, and then credit oil and gas properties, essentially. Depletion calculations should normally be performed prior to the analysis of significant gain or loss. And so oftentimes if you have a company that it may be significant, they need to do a depletion calculation pre-disposal, and then of course then also post-disposal to determine if it meets that significant for change in depletion rate or depletable base. So it might not be a percentage of assets, it might be depletion can trigger it to be a significant. This is a key indicator if, because under full cost pool, and you'll get into this a little bit more in detail, but the depletion rate can be different amongst different properties. And so when you're looking at different costs and whatnot, that might change the depletion rate. All right, to determine if a gain or loss should be reported, you would want to determine the significance of the reserves disposed of, and so a significant alteration would ordinarily be expected to occur for sales involving less than 25% of the reserve quantities of a given cost center, and consider whether the transaction represents recovery costs or a significant disposal. And so significant is typically if there's a change in amortization rate that's greater than 10%. And then, so these are things that we want to make sure that we perform while we're doing, when a full cost company has a disposal. And obviously there's sometimes where it's clearly not significant. If you have a gigantic company and they're selling off just a couple of properties, I mean, it's clearly not significant, but oftentimes we'll kind of need, if it's close or even like might be, make sure the client does a significant test on the amortization and depletion rates. Make sure there's no significant change. All right. If it is determined that there is a significant disposal, then they're going to need to determine the method for allocating that capitalized cost. And then that's something that is sometimes very judgmental, so keep that in mind. And if there are substantial economic differences between the properties sold and those retained, the capitalized cost now allocated to the basis, the relative fair values of the properties. And then issues that may indicate substantial economic differences might be the production life is substantially different, the expected prices differ substantially because of the quality or location, or the degree of development of reserves sold and those retained to be comparable. So those are things that might make a substantial economic difference between the properties sold and properties kept. Then you're going to perform an analysis of fair market value per BOE, or MCF, depending on if it's gas heavy. But these are things that you will need to calculate to determine whether or not there is a gain or loss. And so remember, you can have a gain or loss treatment on disposal, even if less than 25% of reserves are sold. As treated as sale like a normal sale might create a significant change in the DD&A rate. So these are ones that we need to kind of consult and use judgment on to make sure that we're on the right path. So financing on property acquisition. So capitalization on interest on financing. Under ASC 835, it requires that a portion of interest incurred during the construction period be capitalized. It's only for unusually significant investments in unproved properties under full cost. Once proved producing properties, you cease the capitalization. And this is something that I've only seen a couple of times, so it's not something that's normally indicated, but this is something to keep in mind if you do have a company that has a significant acquisition of unproved properties and investment. And then this is only for funds directly attributable to funding oil and gas activities, and then cannot capitalize interest expense greater than the expense actually incurred. So this is another thing so cannot capitalize it and then actually not incur that expense itself. And then also consider what is significant. So if a company is relatively large and they have a smaller unproved property acquisition, that generally wouldn't be considered as significant. However, if you have a company that is growing and they have they're small and they go out and obtain a large unevaluated, then that's something they would rather capitalize it, considering that they're not actually recognizing any income or anything like that until those properties are actually developed. So it's kind of a way to help save it from being expensed right away. Okay. Another item that we want to cover is the overriding royalty interest at acquisition. So this mainly arises in financing agreement as an incentive payment. It gives the receiver a portion of future revenues or production. So I think you guys will go over this a little bit later, but overriding royalty interest is essentially on top of the net revenue interest and expenses. So the overriding royalty interest owner generally does not have at least a working interest. So they're not subject to the expenses, but just the revenues. This may include future properties, not only presently producing. So keep this in mind when we're reading the PSA to make sure that we're considering this unique situation. What properties are granted if they're undeveloped leases, the immaterial values until they're developed, and then if they're producing properties, just keep in mind its valuations. And so we wanted to keep in mind the reserve report regarding future production and potentially complex calculation as related to the ORRI, the overriding royalty interest. Another thing is for the issues related to overriding royalty interest at acquisition. Evaluation is required to be performed at grant date, and in subsequent periods, it may require changes as property is added. So if they're issued in tranches, the change in interest rate might relate to a modification to overriding royalty interest and the calculation based on the effective rate and considered financing cost. And so keep in mind in the reserve report, we need to ensure that the overriding royalty interest is removed from the company's interest in its reserve projections as it relates to the overriding royalty interest at the acquisitions.
So let's wrap up there. Comment with any additional questions you may have, and we can expand and help. Please subscribe so you don't miss any new content. All right, folks, thanks so much for watching. Please like, share, comment, and subscribe. And if you can, donate at Patreon. Anything you can give helps to keep the lights on and ensures we can continue to create content. And of course, helps feed FIFO. If you want to contact us about anything you saw in this video, accounting advice, or ideas for future videos, contact us at patreon.com/accountingacademy.
This video is designed to be illustrative and does not represent an official position. We make no representations, warranties, or guarantees and assume no responsibility for the application of this material. Please seek advice from a competent professional if expert assistance is required.